Today we're talking about how to day trade high probability liquidity. If you really want to make money or more money, you have to find better liquidity levels. But here's the thing, I'm not going to give you a list of hindsight of pre-selected working examples because that is not what you need. What you do need is to understand the psychology behind why those levels work. Get a pen and paper and let's dive in. On my screen here, you will see a bunch of bubbles, and I'm going to use this as way of illustrating how liquidity works and why it actually exists. Let's take a step back. The market, the blue bubble here represents the market. What does the market consist of? The market is consisting of a big portion of retail traders. There's a lot of retail traders. If I talk about retail traders, I'm talking about me, you, hedge funds, banks, institutionals. They are all traditional retail traders, and they go into the market and try to make money and obviously try to survive. But then we've got a bigger force. I call it the bigger force because I don't really know what to call them. If it's algorithms, is it the central bank, is it I don't know, the composite man, whoever they are. All I know is they are a much smaller group of people, if it's a group of people, and they've got way more money than everybody else out there. And this bigger force is basically used to regulate and manipulate and drive the money in the world. And their job is to fish in this pond of retail traders to capitalize from and to profit from and take profit out the market without fail, non-stop, day in and day out. Our job is to try our luck to outsmart these guys and try to make some money from them, which is almost impossible to do. And that's why you'll see 99% of traders lose money, which is this, and only 1% is actually making money. Now you might ask the question, okay, Neil, so what's the point of going into the market to try to make a living or to make money if you're telling me this it's impossible? It's not impossible. And I've got another bubble here, and I call this smart money traders. And I'm just using that name because it's very everybody knows about smart money on the internet. And what a smart money trader is, it's someone that understands how retail trading works and understands how they operate, but also got an idea, not 100%, but got a very good idea of how the bigger force, how it operates, how it works to manipulate the market, this retail market, to capitalize from, and try your very best to become as good as them and try to follow in their tracks, so you can capitalize when they capitalize, because they will be right more often than a retail trader. And that's why if you can trade in line with a bigger force, your profit margin will be much bigger than a retail trader who's trying to break even year in and year out, or make a small gain, or lose money at the end. All right, so now that I've explained to you guys how this bubble works, let's put it in a different term to for you to understand. For you guys who's been in the market, you know where to enter, put stop losses and all of that. We're going to go through a bunch of examples, but before we get there, we need to understand how this whole thing works. All right, so now what I've got here, everybody should know what this is. If you don't, just ask me in the comments, I can explain this. But how it works is, you go and this middle line is where you enter a trade. So I want to buy, and I say I want to enter here. I want to put my stop loss there, and my profit target is right about here. Your aim now is to go and target your profit target. I mean, anywhere between your entry and up here where you are in, that's profit for you. But you're going to wait till it hits your take profit, right? That's your goal. Your goal is not to say, all right, can I get to the bottom of this red block? that is where you're going to lose money. The bigger fours works opposite way around. They saying, all right, if you're going to go to your profit target, I'm going to lose money because you're going to take money from me. My profit target, or the bigger fours, would like to see price goes to your stop loss, because that's where they make money. So whatever you do, they benefit the opposite. So they not specifically come and trade against you each and every time. Because the market is so big, there's people taking trades around the clock. Every millisecond there's trades. It's humans, it's algos, it's hedge funds, it's EAs, whatever that is. It goes into the market on random places. Stop losses are put in random places, and that is just the way and the nature of the market. So we can't say everybody's stop losses is here, and the market won't just go in one direction to stop everybody out and then go the other direction. Then it will become an unfair market. That's what a bigger force will, and you'll see the market will work in waves. It goes up, it comes down, it trends, it consolidates, it's pullbacks, it's all of that. But if you don't know where the liquidity, or the most likely liquidity pool sits, you don't know up to where the market's going to pull back. And if you just look at the market in front of you and just follow what, how the waves are going, you're going to get trapped and stopped out way often than someone that's going to preempt where things are going to turn, or where it's going to stop, or where it's going to accelerate. And that is what you are here to learn and to understand. All right, so let's jump on to the next slide, where I'm going to take you through the different liquidity pools that I trade at high probability. And then at the end, I'm going to show you a fourth liquidity setup that is very specific. It's very high probability, and you're going to be a guru after this video. If you come this far, why don't you type the word profit in the comments below and stand a chance to win a one-on-one session with me to help you fast track your profitability. For every 100 comments, I'll randomly pick one lucky subscriber. All right, so what is equal highs and equal lows? You get the market goes up, it's trending up, and it hits the high, it comes back, it does a little bit of this, it goes up again. That is equal highs. It's highs that's not formed like higher highs. It's basically, it hits a high, hits that high again, and it doesn't move further. It breaks down and go lower, or it goes up a third time. An equal high setup is make out of two spikes into a level that's equal or more. So there can be plenty of this. So what does this mean? Equal highs. Why is that liquidity? All right, so once you look at this graph, you see the market goes up, it pulls back. It goes up, it pulls back. On that pullback, people try to buy, or people buy on the breakouts here. And every time the market moves higher, they put their stop losses there. Put a stop loss there. Put a stop loss there. Put a stop loss there. And then the market refused to go higher. And then suddenly the market drop and stop people out. Now people think, all right, we just turned the corner. We are changing direction. We're going down now. And then retail traders will then sit and say, all right, guys, see how good this level is holding. Price refused to go through that level. And what do? They put their stop losses up here. So they enter the breakout here, and then they put their stop losses out there. The market will then do what it needs to do. Now it manipulated people with a psychological move to say, guys, this is just too unreal. We can't get through it. We have to go down. And then what happens is, boom, we get this big spike up and then drop. And this is where people get stopped out, because there's liquidity resting above these equal highs. And then what happens as well is some people think, This is a breakout to the top side because they were still following the trend. So new people are buying into this, and most people are getting stopped out here to go lower. And that guy who bought this breakout then got stopped out down here. So then this is just taking people for a ride, and this is just manipulating people. And anybody who teaches double tops, double bottoms as reversal patterns or anything like that, do not fall for that trick. Those are prime liquidity pools on equal highs and equal lows, and I'm going to share that with you guys in our examples later on. But let's jump on to the next one. Okay, so in our previous example we talked about equal highs and equal lows, and what I drew there was a trending market going up, breaking out, going up, breaking out, going up, breaking out, and then stop, then do some stuff and stop, and then boom, and that's where I'm going to stop. Now most people, you know, like to trade trend lines, so they will draw a trend line here and to say, oh, it's testing, it's testing, it's testing, and it keeps going higher, going higher, going higher, and that's basically where they would trend and trade towards. Okay, so that's not wrong. So you can make money on trend trading if that's what you do. It's a traditional way of trading, you know, retail. But for us, who's obviously looking at the bigger force, we know that the psychology of that is to say, all right, we're breaking higher. Breakout traders, you buy there, you put your stop here. All right, pull back. That's fine. That's I don't know, a resistance or support. Okay, but we break out, we enter there, we put our stop there. We break out, we put our stop there. Now these is where people put their stop losses, right? And then people put their stop losses here. And funny enough, that looks like equal lows there. But now market has manipulated out there, because now people think, see, we're breaking out again. People buy again and put their stops here, and then aggressively we'll see this big drop here. And that is just everybody who was following this trend goes in, put their stop there, gets stopped out. All right, then the market will go up or do something like that. These guys will still sit and say, all right, we still safe, that was just you know, type of a correction, we'll move higher now. And then we'll see bigger drops down, taking all these stops out right here. And that is basically what I'm talking about if I'm referring to a trend line as liquidity. Whenever you see me trade and I mark out a trend line and I call it liquidity, that's what I'm looking for. That's a target, that's a target, that's a target, and if there's any liquidity lower, I'll target that. And our main goal then was not to trade in line with this, but wait for the market to do a manipulation. We'll see it. I've got an entry model for this, and then take it to the downside, and then you target all of this, and you should not screw around. Price should not screw around to take you there. All right, let's hop into the next one. All right, so now we've gone through the market is trending up. It's doing its thing, it's trapping people on these highs, and then it creates this nice one or two equal highs. We manipulate, and then we see this massive push down, stopping these people out, and just missed this, and starting to pull back. Now the next liquidity that I normally you know, that is very good to follow is when this push down and it inverts a fair value gap, or it leaves a fair value gap in the process. And again, if you don't know about fair value gaps, have a look at my description below. I'll link a video there where I spoke about and take you guys through fair value gaps. Have a look at that so you can understand what this is, but let's go through this. All right, so then say this is our fair value gap, and the market goes up to it, it consolidates, and it makes a new equal high within this. It's not at the ultimate high, but it's within just the bottom end of that fair value gap. That is a great liquidity pool because you know it's an inefficiency and price wants to go back and fill that gap before it continues lower. And what normally happens then, if liquidity builds up in there, it just makes it more high probability for price to go down, and then whoops, slash in it, take those equal highs, fill this gap, and then drop further, taking all this other liquidity out. All right, with that said, I think that's pretty straightforward. And again, the examples will explain this in more detail. Okay, so with that said, let's jump into the real life examples. So I can take you through the 3 liquidity pools, and then I have the bonus out there for you guys on the 4th liquidity pool that I use as a high probability setup. All right, guys, here's a nice example of an image of the chart. Before I put any annotations on to highlight any liquidity pools, what I want you guys to do is pause this video for a second, draw out what you see, and that's a good way of testing that you understand what I'm saying. If you don't want to do that, feel free just to wait a second and we'll carry on. All right, so time's up. I hope you've done what you need to do. That's how you're going to learn, and that's how you're going to do it going forward. I'm going to now switch on my annotations, and let's see if you saw what I saw. All right, let's just take you guys through it. So the market makes a high here. It goes down, it comes back, it refuses to take it out. That is not perfect equal highs, but in my opinion, that's relatively equal. And there's liquidity there. This is also telling people, hey, market doesn't want to go higher, and then it breaks lower, makes a lower high, lower low, lower high, lower low, lower high, and then aggressively push lower, comes back, do that again, comes back, refuse to go back, and then starts running internal liquidity, and then eventually just runs up the page, taking this liquidity out. See, that's your trend line liquidity. Those highs, that's trend line. Our people will trade trend lines, and those highs are all liquidity pools that we will target. I'm only marketing out this equal highs, but this line here, that's liquidity. These are liquidity. This up here is liquidity. All right, so I'm going to extend this so you guys can see it. And then I want you to see how the market make a high. We come there, we create equal highs, we go up there again, and then aggressively start selling off. Starting a new lower low, lower high, lower low, lower high, and then lower low. Not taking this out and aggressively reverse and stop everybody out who thought this was a solid resistance level in the retail world of mindset. But while we did that, we literally left these equal lows now. That's liquidity there. People say this is a news event, market is going up. But in theory, we've got another target up here, and then it went up even higher. You know, again, high, higher low, higher high, higher low, higher high, and then goes and take these out, go back up, take these out. That is telling you we're going lower again, and then trap people forming new equal highs. And remember, we spoke about equal highs that forms on the bottom end of a fair value gap. Now, fair value gap, just quickly for those who don't know, it's 3 candles, and basically that candle here wicks down, a third candle comes pushed down, then a third candle, or second candle, third candle. So the third candle and the first candle the gap that it does not overlap each other, that's a fair value gap. But again, guys, look at my video in the description below, and I can take you guys, and that video will take you through what fair value gaps are and all of that. And yes, equal highs here. Again, people think that's a good place to put a stop loss. Market's going lower, and then pops your uncle, get this aggressively quick push, stop everybody out, and then once it does that, immediately reverse. See this black candle, big black candle, immediately reverse. Some people take the breakout of this and immediately get stopped out because their stops would have been around here. All right, let's move on and see. I mean, there's plenty of examples here, but I've marked some stuff out for you guys. And I think we'll go through some more examples. There's plenty here, guys. There's lows here. There's equal highs here. And but here's a nice example. Price is moving up, equal highs, and then consolidate here, screwing around, and then suddenly aggressive push down, if you can see, and then aggressively push through that and immediately reverse to go lower. That is taking out those equal highs. Let's see. This is it. All right, so I think you guys get a good grasp on the equal highs, equal lows. And again, guys, just want to show you, I mean, that's your trend line. Higher high, higher low, higher low, higher high, higher low, up, higher low, goes up, and then start breaking down. And what did it do? That's your aggressively push down, taking all that liquidity out. And you can mark this out. Then there's a big gap down here, and then I mean, here's a nice example of that equal lows in a fair value gap again. There's your gap, there's your equal lows, price aggressively push in and then reverse to go higher. All right, so these are just examples. Here's another one. A fair value gap forms, a high, a high, a high. That's equal highs, and then suddenly we get this big spike in rejection immediately, and then we see price falling much lower. All right, so I think you guys get what I'm saying if I explain this: equal highs, equal lows, trend lines, and then obviously the fair value gap. I also told you guys that I've got a bonus for you guys, and I'll see you guys in the next slide where I'm going to take you through a super cool liquidity setup. Alright guys, the bonus is the red folder news liquidity, and I'm going to ask you guys to have a quick look at this chart and tell me what you see. Alright, hope you've done that. The red folder news on Friday was this candle at 8:30. That candle, it spiked down, it spiked up, and people always tell, you know, in the retail world, everybody say, listen, if there's news, it's better for you to stay out of the news. I'm saying, guys, I've got a very specific strategy to actually trade the news. And what do I mean by that? This was, I think it was CPI on Friday, and what you do on a 1 minute, you mark out that 1 minute candle, let it run both sides. As you can see, it runs liquidity here, it runs liquidity here, and you mark out the high, and we can call it the CPI high, CPI high, or let's call it news high, news high, and then you get the news low, news low. Because of the news that gets violent over that time, in that minute where it runs up and it comes down, and it stops people out who wants to go long, and then it, you know, trick people in to go low. You wait for that 1 minute to calm down and to finish. Once it's finished, you mark out the highs and the lows. You know, on both sides of that candle, it generated liquidity. And the reason being is everybody who wants to gamble, or who's breakout traders, or someone who tried to catch the move quickly, is going to be enticed to, when it rush up, that the market's going long, and when it pulls back and rush down, people think that was just manipulation, we're going the other side, and then what happens? We stop right in the middle. All you got to do next is, because you don't know which side of the liquidity we're going to run first, so you just wait for the market to run one of the high or the low first. In this case, it dropped through the low, and then here it gave me a entry to go long. So the market went up, came down, enter me on this fair value gap, and then my target would be news. But again, guys, remember what I told you. There's the trend line on here. Where did we go to? We went here. Oh, and so by the way, there's some equal highs there as well. So we had equal highs, there's liquidity here, there's liquidity there. We didn't go there, but there's equal highs there. We spiked to that. That would be your first target. That could be your first target right there because it's liquidity right very close. And I normally, and if you look at my entries, because of the entry down here, and not to teach the inverted fair value gap and stuff right now, that's an inverted fair value gap. We came and tested, that was my entry, my stop was just below this. The minute we crossed this high, I went to break even. Yeah, you can take 80% of your profit off and leave the other 20 to the next possible high probability liquidity, knowing that there's some liquidity left, and then the market run all the way down. Funny enough, guys, I'm just showing you what the market is doing. The market is designed to run from liquidity to liquidity. Here it ran liquidity. I'll show you my replay at the end of this video of how we executed Friday. We ran liquidity lower. We then went to liquidity higher. We came down, we create new equal lows. We ran that. We create new equal lows down here. And I just want to show you the power of this. The equal lows down there. Knowing that we've got this liquidity up here. Price ran up, ran all that liquidity, and guys, tell me, what do you see? We can start preparing a trend line liquidity. There's equal lows, hasn't been taken yet. There's some equal lows here. All you got to do is follow the trend here. That low, and you can actually mark that out. Sorry, that's equal lows. The trend continues, but now we know there's all this liquidity with this down here. Let's just mark it out. This is all Friday, ladies and gentlemen, and let's make it smaller and show you what eventually happened. And we went Bob's your uncle straight to those equal lows through this trend line. And what do you see is happening now? We are now forming new liquidity. And that's where we are. I don't know if the market will just run up on Monday. It could gap up. Doesn't matter. And before I go, guys, and show you guys the last the last section of this video, I want to show you one more example. I'm going to take all the drawings off from here. I'm going to jump to a daily. This works on every time frame. This is not handpicked. What do you guys see here? All right, besides all this liquidity here, obviously this is daily. That can take a long time to come back down here. But where we are right now in the daily, we formed nice liquidity to the downside. We formed that was equal. I mean, you can see these fairly equal lows. We ran through it, gave the entry test, enter, and we are now at a point where we print equal highs. So the market has come down and form new equal lows, and then suddenly push higher. It's in a gap right here, so at this point in time on lower time frames, I'm bullish to take out these liquidity. This can go up here, create new equal highs, and then come down to take these equal lows out. That's where we are on the daily. I'm just showing you guys, this is literally, I mean, if you look at the hourly, you'll see it. When you look at 4 hour, 5 minutes, 1 minute, every time frame you look at, you'll find this. And let me tell you one thing, all you got to do is, if you can master where the liquidity, where liquidity is forming, you would know when we run liquidity on one side, the obvious liquidity is on the other side. and the market's going to make a move to go to the other side. As you can tell, it's all about understanding the market and how it's built to work. All you need to do now is watch price, mark out the levels, and see how it behaves based on what you've just learned. The time you put in and experience will make you a better trader. It will simplify the way you see the market. Charting time and guidance to help fast track your journey to profitability. This is the thing I help traders with. So if this is something you're interested in, make sure to check out my channel for more content like this, and join me Monday to Friday where I trade these setups live. I'm not lying if I tell you this channel is the best value and guidance you'll get for free. So make me part of your journey, like and subscribe, and I'll see you in my next video or live stream.